G'day everyone, welcome to the weekend general update for the 12th of May and another very strong week in overseas markets and also in the Australian market. And we're certainly seeing what looks like the start of a sector rotation. We've had the banks and the financials going gangbusters since the middle of last year, and resources being absolutely belted. But there's just some preliminary signs that resources could be making a comeback, and that some of the major money flows around the world are starting to come back into the resource sector now as people start to look for a higher return, and they're prepared to move into the more risky part of the market in order to get that return. So let's have a look at a summary of what happened last week. The S&P ended up jumping 20 points. And the momentum in the US really is quite stunning at the moment. As we'll see on the chart in a minute, all good things will have to have a bit of a break and a bit of a breather, but certainly looking very strong at the moment. The Australian index also performed well, higher by 77 points on the week, and as I discussed, definitely some signs of a sector rotation into resources. But also small caps making a pretty good comeback as well after really suffering over the previous couple of weeks. Now the risk outlook in Europe is still receding, and the best way that we know that is you can look at all the economic data you like, and from month to month those data points go up and down. But really you've just got to look at the trends in government bond yields, because that really tells you the level of concern that the major players might have for things going wrong in Europe. And the yields are telling us that they're not very concerned at all. We've got Spanish bond yields now down close to 4%. We've got the Italian bond yields now down under 4%. So the risk premium there has shrunk dramatically. And that's obviously having an important consequence on markets around the world. Now the US dollar was higher on the week, took a sudden jump in the middle of the week, and it was largely on rumours that QE3 would be ending, and that just keeps coming up over and over again. But I can tell you it's not going to happen. Central banks are between a rock and a hard place. They have to keep interest rates at effectively zero, and they have to keep printing money to pay for government deficits. Neither of those circumstances are going to change. So you know, QE3 is going to continue. It's going to continue in Japan, it's going to continue in Europe, and it's going to continue in the UK, and there's really no end in sight to that process. And in fact, if anything, there's more money being printed. Well, definitely there is more money being printed now than there was 6 months ago or 12 months before that. And any examination of a reversal, or any examination of any physical principles, tells you that something's got to slow down before it can turn around and go the other way. And the amount of money printing going on around the world is actually accelerating. It's not decelerating. So I think we can forget that one for the time being. Now gold lost $22 on the week, and that was largely a currency impact. The US dollar went up, so the price of gold went down in conjunction with that. But as we'll see on the chart, 1470 retracement level is still a bit of an obstacle. We need to close above 1475 to indicate that we've probably seen the lows. Copper strongly higher, bounced back to 335. It got down pretty close to $3 at one stage. And oil was steady at 96, and there's the spot copper chart over the last 6 months. You can see we formed a double bottom here from the middle of April through to early May, and we've had quite a strong surge back in copper. So let's have a look at a few charts. This is the S&P 500. So we look at this every week, and we can see that we've now formed a higher high on a big picture. So it's blue sky, there's no resistance up there, so we don't really know how far this is going to run. But I'll just make one observation. If you have a look at this red moving average line, it's the 150-day moving average, and the value of the index is as far above that 150-day moving average as it ever gets. In fact, probably further than it ever gets. And at the end of the day, all things revert to the mean. Now, you wouldn't want to be trying to short this because the upward momentum is just awesome. So we've just got to wait and see until it shows us that it's reversing, but you just have to know that this is not going to keep going at this current rate. You can see the current rate of ascent is taking it quickly further and further ahead of the moving averages, and it will turn around and come back. However, the momentum is just so strong that as I've been all year, of the view that any corrections that we get are going to be relatively mild and relatively shallow. So I think that's where we are with the S&P. Now, looking at market breadth, it's one thing to look at the major indices, the Dow Jones and the S&P, and say that they're going well, but quite often that can be because of strength in the handful of the bigger stocks. What you've got to do is look at some of the other indices, such as the Nasdaq and the Russell 2000, which is the smaller stocks, just to make sure that they're healthy as well. This is the Nasdaq index, and as you can see, it's extraordinarily strong. So just zeroing in there. Now, if we put a moving average on this one, you can see the Nasdaq also getting considerably ahead of itself, but there's no question that this upward momentum has enormous strength. So we are going to see a correction, but the momentum is really just quite awesome. Let's have a look at the Russell 2000. Now, this was setting up. We did have a falling wedge pattern. We had some divergence with the S&P, and that was the correction that I was concerned about in April. So let's just take that off there because that really no longer applies. And you can see we've now broken to the upside, and the small caps are now charging back as well. So not only are the main indices going up, but the breadth in the American market is very, very strong. There's a lot of money shifting into the US market at the moment. Okay, let's turn to gold. And as I've been showing now for a couple of weeks, we've rebounded to the 50% level. So we've come back 50% of the decline, which started on the 21st of March and ended up with the crash in gold on the 16th of April. We've come back 50%. It's not unusual that we've had about 6 or 8 days sideways. We're now getting a little bit of a retracement of that uptrend, but as long as it doesn't go much below where it finished on Friday night, which was a low of 1420, and then can close above around 1475, then I think we're back into uptrend. I think we've seen the lows at that point. So we'll just have to wait and see how that particularly plays out. This is the GDX index, the Gold Miners Index. You can see we're getting quite a consolidation occurring here, but then again we had a consolidation here in basically the month of March. So that in itself is not adequate. We're still below the 150-day moving average, which is this one up here, the purple one. The red line is the 50-day moving average. They're both still heading down quite sharply. The price is below them, so all you can say at this point in time is that the Gold Miners Index is still in downtrend. The important chart that we need to look at is the spread chart between the GDX divided by the price of gold. So we look at this chart every week. This is really the canary in the coal mine for me. We need to see this ratio turn up and break that moving average line. That will indicate that stocks are now outperforming gold, and that almost always happens before the price of gold bottoms. So we're looking for this ratio to turn up, cross this moving average line, form a higher high, and then I think we'll probably see gold stocks starting to take off to the upside, and probably within a month after that we'll see we'll have a confirmation of the low in gold. So this is really the key indicator that I'm looking at. Just have a quick look at silver. Silver's really hasn't done very much really. Gold has been more volatile than silver in the last 3 or 4 weeks, which is quite unusual. Usually silver is a much more volatile instrument than gold is, because it's such a smaller market. But pretty low volatility. You can see these Bollinger Bands really starting to pinch in now, and I would expect that we will see a breakout in volatility in the not too distant future. Hopefully it's to the upside in silver. Final chart I want to take a look at is the ASX 200. It doesn't tell us a great deal. It's really only a reflection of the banks, Telstra, BHP, Rio, and that's about all. I don't focus on it too much in terms of the levels. You can see there's a pretty good trend, but that's really a reflection of the strength of the banks. If we look at the banks over the last week, you can see that they've basically flattened off and declined a little, which is what you would expect, because they certainly do look fully valued. But if we look at resources, you can see there's a sharp rebound going on in resources. So that's the sector rotation that I was talking about. So that's it for this week. It looks like it'll be a reasonably good opening to the Australian market on Monday, and until the US market decides it's going to correct, and that could still be weeks away, then things should be pretty good. So that's it for this weekend. Cheers.